Hello, Maverick traders. Welcome out to your market roundup for August 30th. Corey here with you. As always, a quick reminder to make sure you follow your trading plan. Now, there has been plenty of selling pressure the last few days, last couple of weeks, really, in the markets. We'll make sense of that together, but let's review what's happening today and some of the important news and such. I'm going to start here in the top right-hand corner. You can see all of the indexes down about 1% on the day. Oil, a particularly bad day, down 5%. Gold, which we highlighted as a bearish idea last week, down 1%, and has been selling off in the past week. We'll get to the heat map, but definitely bright red there in energy. Advanced decline lines, 76% of stocks going down today, about 20% up, and 4% going sideways. The 50-period moving average has now flipped. We're more bearish than bullish, with 55% of stocks below the 50 MA, 45% above, but that kind of tells you we're in this equilibrium market. It's not a widespread bearish or bullish. Now, it's been my argument. I've talked about this the past few weeks. We'll reiterate that a little bit more today, that we're still in a bear market. Daily news, quantitative easing, the balance sheet reduction really begins at this point in time. And so the Fed has this huge $9 trillion balance sheet, and they're going to start to reduce that. And part of that happens naturally, meaning that they had been buying bonds, and bonds have a maturity date. At maturity, the money is paid back to you. What the Fed had been doing is taking that money when the bond matures and rolling it back into a new bond, buying new bonds with it, sort of keeping that quantitative easing or that bond pressure where they would keep buying bonds to drive down interest rates. And that's obviously dovish and drives the economy higher by keeping interest rates artificially low and so on. Well, that's beginning to unwind. And so this is really the start of that, where there's these bonds, as they mature, they're going to go away. That money gets paid back, and that is a shrinking of the balance sheet. So we'll see how the markets handle that. Again, it's one element of why we're still in a bear market overall. Consumer confidence did bounce back this period, back up to 103. Now, that's not a percentage number. That's just to suggest we're seeing a little bit of an uptick, the consumer feeling a little bit better. And that makes sense given that what the consumer has really been voting on, and the reason that consumer confidence numbers have been in the dumps, is because they're highly influenced by the price they pay for certain things, specifically food and energy and inflationary items. And that has been a big problem, but prices have backed off recently. We've seen oil more in the 90s, not in the 100s. And we've seen food prices and some other things kind of back off. We've seen copper and steel and lumber prices and those sorts of things back off. So inflation has taken a step down. Let's look at some charts here. So we broke and closed below the 50-period moving average today. Now, we didn't need to wait for that to happen to know we're still in a bear market. We've been in this kind of corrective phase. We've said, look, we're in a short-term uptrend. But I got pretty darn nervous as the market was coming up here. This is where the market runs into the 50-week moving average. We'll look at that here in a second on another chart, and the 200-day moving average, which are similar type of signals, kind of that you're still in a bear market even though we've had a short-term uptrend. And sure enough, the selling pressure has come back in earnest the last couple of weeks. So how do you react to this break of the 50-day today? I think it's one more thing that's not great looking, but certainly we didn't need to see that to kind of say, okay, the market's in a little bit of a rough spot. It does suggest maybe a little bit more selling in the short term. This was a place I frankly would have expected the market to at least bounce, if nothing else, and it didn't even really give a bounce. It just kind of sliced right through. So I don't think you have to rush out and sell it by any means. And I think it's a little, newer traders might go, well, I'm bullish because we're above the 50. Oh, now we're below, so I'll hurry and change everything. And I think that's the wrong approach. It's more like weighing the evidence and kind of looking at where you're at. And I wouldn't be rushing out to be super bearish just because you close below the 50-day, because we're kind of stretched. we've sold off for the past couple of weeks. There will probably be bounces and so on. I would use it as, okay, it's another bearish thing. I can adjust the portfolio a little bit, but I don't want to be making, massive changes. We might flip-flop. We might go back above the 50 tomorrow, and you wouldn't just change your entire portfolio back to bullish because that happened. You use that as a gauge. I would also say that there's some conflicting signals in that the 50 is sloping upward. So that's a little bit more, bullish, but the close below it's bearish. Again, I think we're in kind of a choppy environment here for a while. So I wouldn't take that as being, oh, we got to act quickly and such. I think it's going to be a little bit of a choppy market. The QQQ, kind of the same thing. Now, I've been bearish on the markets the last couple of weeks, and the reason has been this chart. I pulled this up for the first time 2 or 3 weeks ago. I guess it was, we were pretty darn close to that high, but that was the reason that I pulled it up is basically, okay, you've come all the way back up, but are we out of the woods? And this was my commentary that to me, we're in a bear market in essence because of the combined result of this whole entire chart. This is a long-term weekly chart. It's not just the fact that the 50-week moving average is sloping downward. It's not just the fact that we're still below it. It's not just the fact that we're making, lower highs and lower lows. It's not just the fact, look at this down trend line. We're right at the down trend line. It's not just the fact that it's a combination of all of those, right? That in essence, I felt like we're going to be in a bear market, and then you can look at sentiment, you can look at fundamentals, you can look at what the Fed is doing. If QE was great for stocks all throughout this phase, quantitative tightening and the fact that we're now getting a massive reduction in the coming years of the Fed balance sheet and interest rates are still going up and so on and so forth. And it's a combination of factors that really tells me I think we're still in a bear market. It's not just one thing. It's the combination of those. And that's why I was trying to highlight that a couple of weeks ago was because it's an important level, but it's a combination of those things that all kind of point towards a weaker market environment. So that's what we've been seeing the past couple of weeks. I've looking at this, I highlighted and kind of emphasized some of the large cap healthcare names as bearish candidates. I do somewhat have to take that off, take profits in and some of them, I mean, Bristol Myers, we highlighted a couple of weeks ago, that thing's down like 30% in 2 weeks or something. Johnson & Johnson down, Pfizer down, and so forth. But I would say, profit taking in that sector makes sense to me. And my inkling is that the market's kind of turned bearish enough in the very short term that I would prefer waiting on some sort of bounce to get short. Certainly very bearish in energy, the industrial space, that might be an interesting one to continue to look to the downside on. And then in the bullish side, there's just a little bit more green in financials. I'm actually going to look to there a little bit for bullish candidates, but let's make sense of this together. So in the short term, long term, I think we're still in a bear market. In the short run, even though we broke and closed below and such, I actually think we probably do bounce. We probably see a couple of day bounce coming up in the not too distant future, for a couple of days, and then we'll assess that. If there's a really strong rally, we really could stay in a consolidate. It could kind of rebound us back up where we consolidate for a couple of weeks. If it's very tepid, it probably just rolls over and we get some continued selling. I want to look at some things, and I'm not really super confident that I want to do anything very aggressive right here and now. But I think we've got to move some of these outlooks to more bearish, like I've been saying the past couple of weeks, given the risk to reward of it. So let's look at things in terms of potential candidates and ideas. I've got a couple on the bullish list, a few on the bearish list. Let's make sense of them. Here's EQT. Now, we highlighted this for the first time back here, I remember. This is one of the biggest natural gas producers. This and LNG and some of those. Oxy we've highlighted as an energy play. Energy got slammed today, but I think this could still be interesting as a candidate. You got a big cup and handle here. Basically, a resistance, it's held, and we're kind of creating that handle effect is what I would expect this to play out. So do I expect it to just go bombing to the downside? I don't. I actually think we'll go up and out from here. So I'm going to give this the benefit of the doubt. I'm not ready to buy it just yet, but another day or so of consolidation right down there around $46 per share. I think we can take an action. And if you wanted to be a little bit more mathematical about it, you could say the top of the range is around 50. The bottom of the range is around 31, we'll call it. So 50 to 31 is 19 points. That's the size of the cup. The handle will usually be about 30% of the size of the cup. So if the cup is 19, 30% of 19 is 570. Yes, I used a calculator. So if we back off about 570 from 50, that would put us at about 4430 would be about where the bottom of the handle should be, right around 4430. So a little bit more downside, like I said, a little bit more consolidation, but I want to be a buyer on just a little bit more weakness and stabilization. PayPal. So PayPal has kind of had a classic bearish to bullish reversal. We've gone through these phases, and this is how price action often looks. It's messy, but see how there's these corrections in a bear market, and then you go to new lows. And, it's not, it would be nice if every chart was just so clean that it just perfectly zigzagged and whatnot. But it tends to get a little messy. You got to see the big picture throughout that kind of messiness to it. And here I think is what we're in. I think we're in a little bit of a bearish correction within a bullish turn. So I still anticipate that this gap area around 90 is probably about the area you want to start looking to buy PayPal for the next run up into the 100s. Financials have a little bit of sneaky strength right now in the markets. I was considering a couple of other names that looked a little bit better than most, and so financials could be interesting in this space. Here we have Trade Desk, TTD. I highlighted this one last week, but I said I want to wait for kind of a bigger drop, a scary drop. I thought there would be kind of one big selling day. What I envisioned was a big red candle. We didn't really get that, but today's candle was pretty big, what we would call a high wave candle, and finished actually positive on the day in a bad tape. I think that's kind of what I was looking for. So I'm looking to buy here, and I think we head back up towards the top end of the range. Trade Desk, again, very much better than the majority of stocks, both in the very short term, intermediate term, with this huge gap up and such. Just looks better than most. As we look at the bearish side, we highlighted this as a potential bearish candidate. This is an energy stock, and I had quite a few bulls. I actually do not yet have a position on this on the bearish side, but I did take profits on part of my Oxy trade and Apache and some energy plays that I had on. I did that actually before today. I did that at the end of last week, so it kind of looked like I'd taken profits too early yesterday, and now it looks like I took profits at a great level as of today. But anyway, I took some profits off on a lot of my energy, but I still think because I'm looking to buy some of those energy plays, I would almost like to play something against it and be a little bit market neutral that way, where if I have energy to go up in some of my favorites that way and then an energy play to go down here, that can make sense. I'm not sure why this one's lagging in such an extreme fashion, but usually where there's smoke, there's fire. Garmin, we've highlighted this one on the bearish list. Kind of an inverse cup and handle that has broken, and I envision further deterioration. So this is one of the stocks that I've liked on the short side for really months. We've probably had it up multiple occasions, but I continue to like that one lower. And then Johnson & Johnson, I brought up these large cap healthcare names because I had talked about potential bearish trades on J&J and BMY and Pfizer and name some of these, and they've really sold off pretty sharply. Johnson & Johnson not as much as Bristol. This one sold off the most, but anyway, the last couple of weeks have been big drops. I mean, a move from the 170s down into the 160s, that's a pretty big move. Bristol Myers, interestingly enough, has also gone down 10 points, but it's a much lower price point. So that's like a 25% drop or what have you. They've sold off enough and they're defensive enough that I think, kind of like we talked about Simon Property Group and taking profits on that neutral trade idea that we'd had out there for a few weeks, I think it's not necessarily time to take profits, but I don't want to short them at these levels. I'm kind of done with uh, initiating new trades. And if you have trades, consider some profit taking opportunities or adjustments that can lock in some gains, that sort of thing. But that's been a good trade and a good bearish idea. Markets are still in that bear market. Even though we had a nice run in the short term, that's how I see it. We are in an overall bear market, so you're going to have some sharp declines. You'll have some big rallies. There's more volatility in bear markets, so that's going to continue to be the case. And look, the VIX has been living above 20 most of this year. That speaks to we're still in a bear market. Even when the market's rebounded, the VIX is still up there in the 20s. That's bear market activity. Anticipating another push down to those prior lows, I still think that's the play. ISM manufacturing on Thursday, payrolls on Friday. Earnings season is winding down. We still have Broadcom, Ciena, Hewlett Packard, I think, is reporting tonight, Lulu and MongoDB and so forth. There's a few companies still coming through that could be interesting, but for the most part, earnings season is now wound down. We won't get a new earnings, really big influx of important earnings reports until the fourth quarter. Hope you've had a great week thus far. Keep it up, and we will see you next time. Goodbye, everyone.